Hello folks, this is Russell Shor from the Shor Report, and I'm here just to let you know that you can grow your wealth through competent investing on the JSE, and you do have an advantage in being a smaller investor in that you're more nimble, and because you're more nimble you can beat the pros at their own game. And truly the JSE is one of the finest ways that you can grow your wealth. Now, just as a precursor to this video, I'd like to introduce you to a typical stock market cycle. Generally, what happens is a market has a stage one accumulation before a bull market gets underway. The bull market then ensues. Stocks inevitably become overpriced, and there's what we call a stage three distribution, and then a bear market ensues. And once that bear market is finished, the accumulation starts all over again. And that's how the stock market tends to cycle. Now, the whole idea behind the Shor Report is to be a participant in the stock market during the accumulation and the uptrend phase, and then start exiting through the distribution phase and not partake at all during the downtrend, which is obviously when portfolios get absolutely obliterated. Now, it's very important to understand that when you're building your portfolio, it's going to be subject to what we call a normal distribution. And generally what will happen is most of your positions will either be small performers, in other words, they'll make small profit, or they will be small losers, they'll make small losses. And generally these small profits and these small losses tend to contra one another out. But then as you move to the right hand side, you get a small part of your portfolio which are massive winners, and as you move towards the left part of the distribution, you have a small part of your portfolio which are massive losers. Now, the whole idea behind the Shor Report is to manipulate this distribution curve. So effectively what we want to do is we want to shift the distribution curve out so that we are participating in only the very best stocks, the very best investments out there, so we can grow that wealth as quickly as possible, but we're going to do it in a very responsible manner. Now, there's a lot of information to cram into this short video, but inevitably what we're looking to do is we're actually looking to skew the distribution curve. So what happens here is you can see that we've actually got a much longer sample size on the right hand side and a much shorter sample of losses on the left hand side. But that's not good enough for us. Those losses on the left hand side can still cause real damage to the portfolio. So the Shor Report looks to actually cut those losses out completely and take advantage of this long tail right hand side of the new distribution curve. Typically what you'll find in a publication of the Shor Report is the top 25 stocks as measured by an indicator called the rate of change. And what you'd look to do is invest in the top 10 initially, and there's very strict risk control measures, and I'll explain a little bit about that in the next slide. And what happens, you'll hold your portfolio until one of those positions fall out of the top 25. If it drops out of the top 25, it's telling you that the momentum behind that particular stock is starting to wane, so you'll exit that and you'll cycle into the next best stock in the list that you don't already own. Now, the whole point behind going into the strongest stocks and cutting those losses very quickly is summarized very well in this table. In fact, this table is the most important slide in the whole presentation. And what it's basically telling you is the more you lose in the stock market, the harder it is for you to actually build those profits. So if you lose 10%, you actually need 11% just to break even. And I'll just give you a very quick rundown of how that works. If you've got 100 Rand and you lose 10%, you have lost 10 Rand, so you're left with 90 Rand. If you make 10% back on the remaining 90, you've only made 9 Rand back. So you've lost out that 1 Rand. So the mathematics behind it is quite cruel. The more capital that you lose, the harder it is to be a successful investor on the Johannesburg Stock Exchange. And the Shor report is very, very cognizant of that. The objectives of the Shor report are very simple. Number one, we want to preserve your money because obviously, just like the last slide said, if you lose your money, it becomes exceptionally difficult to be a success on the stock market. What we'll also do is we'll let our profits run. We'll take advantage of that right-hand long tail that I was talking about. We want the real stars to perform, and we've got specific exit criteria to make that happen. And at the same time, we'll cut our losses very, very quickly so that our portfolio does not get damaged by them. So what I'd like you to do is I'd like you to take advantage of a free trial that we're offering at the Shor report. You'll see below this video there is a form for you to fill out where you can enter your name, enter your email address, and then just click on register for free trial, and that will entitle you to a 1-month free trial of the Shor report publication. I hope that you found this short video worthwhile, and I hope to speak to you guys soon. Thanks very much. Cheers.